The market isn't made of numbers. It's made of people, their fear, their hope, their illusion of control. And one man, more than a century ago, learned to read it like a language. His name was Charles Dow. Imagine New York, 1896. The streets are narrow, the air thick with the smell of coal and ambition. Men in bowler hats shout over one another as telegraph wires hum with the heartbeat of Wall Street. Paper tickers spill across wooden desks like serpents, spitting out streams of prices that rise and fall faster than the human mind can follow. In the middle of that storm sat Dow, quiet, deliberate, an observer rather than a participant. He was the richest man on the street. He was even a trader. He was a journalist. But where others saw chaos, Dow saw structure. Where others tried to predict tomorrow, he was decoding truth itself. He believed the market was alive not as a creature of numbers, but as a reflection of collective human emotion. Every price, every tick, every swing was an echo of greed, fear, and the eternal struggle between confidence and doubt. He called it the average. But it was far more than that. The Dow Jones average wasn't just a collection of stocks. It was a living mirror, a way to measure the heartbeat of capitalism, the rise and fall of collective optimism. It was his attempt to turn chaos into order. And in doing so, he quietly gave birth to the first real market theory, the foundation of every chart, every indicator, every line traders draw today. Dow didn't shout his ideas. He whispered them in editorials, in the Wall Street Journal he co-founded. No flashy predictions, no wild claims. Just quiet observations that markets move in trends, that trends confirm one another, and that behind the flicker of price lies the rhythm of human behavior. He called it logic. History calls it genius. Even now, more than a century later, when traders open their screens and trace lines across charts, they are not just analyzing data, they're following Dow's footprints. He never saw a candlestick chart, but he understood every flicker of emotion those candles represent. He knew the market's truth wasn't found in headlines, but in patterns. And patterns, he believed, were simply human nature repeating itself in public. So when we ask, what moves the market? We're really asking Dow's question. Because long before algorithms, before news feeds, before Twitter and trading apps, one man sat in a dimly lit room and realized the market wasn't moving at all. It was us. If you could sit beside Charles Dow for one trading day, what would you ask him? Comment your thoughts below. But even Dow's calm logic faced its greatest test when he looked deeper into the market's paradox, that the same force that creates trends also destroys them. Every trader wants to predict the market. But Dow learned that the moment you try to control it, it controls you. The paradox of the market is almost poetic. It rewards discipline, yet punishes certainty. It moves in patterns, yet mocks anyone who believes they can see the future. And no one understood this tension more than Charles Dow, a man who spent his life measuring something that could never truly be measured. Dow's mind was analytical, almost mathematical, yet his soul was philosophical. He believed the market was a mirror of collective psychology, a grand theater where fear and hope fought for dominance. But the deeper he studied it, the more he realized the contradiction that would haunt every trader after him. The same patterns that brought clarity also created illusion. Dow saw that traders desperately wanted the market to be consistent. They wanted formulas, rules, guarantees. They wanted to believe that success came from knowing when prices would rise or fall. But Dow's observations told him otherwise. Markets, he realized, don't reward knowledge, they reward alignment. He wrote, The market reflects everything known and everything feared. In that single line lies the paradox that defines every era of trading. The more you try to predict, the more your own emotion enters the equation and distorts what you see. Dow compared it to the ocean, vast, powerful, beautiful, and dangerous. Each wave had purpose, direction, and energy. But within that rhythm were smaller tides, ripples, and unpredictable storms. You could read the current, but never the next wave. That, he believed, was the essence of trading, to ride the rhythm, not to command it. This was the birth of what we now call trend theory, the recognition that markets move in phases. An upward tide of optimism, a crest of euphoria, and then the inevitable pullback into despair. Dow called it human nature on display. He saw three types of moves. The primary trend, the great ocean current, slow but unstoppable. The secondary reaction, smaller tides moving against the larger flow. The minor fluctuation, surface ripples that distract the impatient. What made Dow's thinking so profound was that he didn't see these as price patterns. He saw them as psychological waves. Each movement was a manifestation of human belief, confidence expanding and contracting like breath. And here lay the true paradox. If you tried to fight those waves, you drowned. But if you learned to float with them patiently, without ego, you could travel farther than anyone else. Even today, this tension defines the trader's mind. Every chartist, every algorithm, every strategy is still fighting the same invisible war, the desire to know versus the need to accept uncertainty. Dow's genius wasn't in predicting direction. It was in teaching us that uncertainty itself was the market's constant, and mastery began with surrender. If you knew the market could never be controlled, would you still trade it? Tell me your thoughts below. Because as Dow kept watching the market's rhythm, he uncovered something far more dangerous than volatility, the psychological trap that blinds every trader who confuses information with wisdom. Dow realized the market's greatest deception wasn't in the prices. It was in the trader's mind. As Charles Dow watched the markets every day from his office window, he saw a strange theater unfold, not on the trading floor, but within the hearts of men. He saw how logic dissolved in moments of greed, and how intelligence evaporated under the heat of fear. He realized something uncomfortable, something every trader eventually faces. The market doesn't punish ignorance, it punishes emotion disguised as reason. Dow's life was built around observation. He didn't speculate wildly or gamble recklessly. He studied patiently, silently, methodically. And what he noticed again and again was that the market didn't move because of information. It moved because of interpretation. Two men could read the same news and act in opposite directions. One would buy in hope, the other would sell in terror. The difference wasn't the data, it was their psychological state. Dow began to see that prices were simply reflections of those inner storms. Each tick on the tape was a heartbeat, the collective pulse of thousands of minds reacting, predicting, regretting. And this is where his true genius began to surface. He didn't just want to understand the market. He wanted to understand the people inside it. In his writings, Dow described a curious pattern. Traders didn't fail because they lacked information, they failed because they couldn't handle truth. They chased noise, mistaking every movement for meaning. They confused activity with progress. They became addicted to the illusion of control, believing that if they just read enough, calculated enough, analyzed enough, they could outsmart the tide. But Dow knew better. He saw that this obsession was the real trap. The market, he said, was not a puzzle to be solved, it was a mirror. And most men, when looking into that mirror, didn't see opportunity. They saw themselves impatient, fearful, uncertain. He often wrote about confirmation. Traders, he warned, look for evidence that agrees with what they already believe. If they buy, they seek bullish headlines. If they sell, they hunt for reasons to panic. In both cases, they stop observing reality and start defending ego. That, Dow believed, was the fatal wound of most market participants. They weren't reading the market. They were arguing with it. He once noted, the market discounts everything. And by that, he didn't just mean external information. He meant you. Your bias. Your hope. Your fear. Every emotional reaction becomes part of the market's collective rhythm, feeding the very patterns you think you're analyzing. That realization is both terrifying and liberating. Terrifying, because it means the market knows your weakness before you do. Liberating, because if you can quiet that noise, if you can separate observation from emotion, you start seeing what Dow saw. Structure in chaos, law beneath illusion. Even today, traders repeat this same trap, scrolling, refreshing, second-guessing, overanalyzing. They drown in information and starve for wisdom. Dow's greatest insight wasn't a theory, it was a mirror he held up to every trader's mind. Be honest, when the market moves against you, what do you feel first? Fear, anger, or disbelief? Comment below. Because it was only after watching these emotional storms that Dow developed his most powerful belief that the market itself could teach discipline if you learned to listen, not predict. To most, the market was noise. To Dow, it was language, and he had learned to listen. Charles Dow was not a man of excitement or drama. He didn't chase headlines or indulge in speculation. He preferred observation to action, reflection to reaction. And that, perhaps, is why he saw what no one else did. Dow believed that the market was not a battlefield of prices but a living record of human behavior. Every rise, every fall, every pause, it all meant something. Not in isolation, but in sequence. He saw that markets speak in patterns, not words. And if you learn the rhythm, you can hear what the crowd cannot, the quiet truth beneath emotion. From his small office at the Wall Street Journal, Dow watched the ticker tape roll endlessly, hundreds of numbers flickering every minute. Most men saw confusion. Dow saw conversation. He watched industries move together, confirming or contradicting each other. He saw railroads rise while manufacturing lagged. And he knew this was no coincidence. He realized that when one sector moves, it whispers about the health of the others. And when all move together, the market speaks with one voice. That was the foundation of his belief that confirmation reveals truth. He wrote that no market signal stands alone. If the industrials are climbing but transportation lags behind, something is incomplete. But when both move in harmony, that's conviction. That's truth verified by behavior, not opinion. Dow wasn't predicting. He was listening to alignment. He believed that human beings, when acting together, create a natural order, and that order can be observed through price. But what made Dow extraordinary wasn't just his analytical insight. It was his humility. He never claimed to know where the market would go tomorrow. He never tried to be smarter than the tape. He simply watched, and trusted that truth takes time to reveal itself. In his eyes, the market was like the ocean. You cannot fight it. You cannot rush it. You can only observe the tide, understand its rhythm, and learn to move with it. He believed in patience, the kind that modern traders rarely practice. He once implied that the market rewards those who can wait without wanting. And in that stillness, clarity appears. Dow's entire philosophy could be summarized in a single sentence. The market discounts everything. Not just data but emotion, politics, world events, and sentiment. To Dow, that was liberation. Because if everything is already priced in, then your job is not to know more, it's to understand better. And this is where Dow diverged from the rest of Wall Street. While others chased advantage through information, he chased understanding through observation. He didn't want to outsmart the market. He wanted to understand its nature. To him, the tape was like a diary of human behavior. A record of how greed inflates and fear deflates. He could see optimism in long uptrends, exhaustion in sideways moves, panic in sharp declines. It wasn't technical analysis to him, it was human analysis. Today, when traders draw lines on charts, they are unknowingly retracing the eyes of Charles Dow, a man who turned noise into narrative and data into philosophy. If you could ask Charles Dow one question about today's markets, what would it be? Drop it in the comments below. But Dow's ideas weren't just theories on paper. They came alive in the real world in moments of crisis, in the hum of ticker tape, and in the feverish heart of Wall Street itself. And one story would prove just how right he was. The year was 1896 and the market was bleeding. But to Charles Dow, it wasn't a crisis. It was confirmation. Picture Wall Street in that year, a storm of panic. Banks closing. Investors shouting in disbelief. Fortunes evaporating before lunch. The sound of the ticker tape machine echoed through trading rooms like a drumbeat of despair. Click, click, click as numbers fell faster than men could read them. Most saw chaos. Dow saw rhythm. He watched from his modest office in Lower Manhattan, papers scattered across his desk, a single candle burning beside the ticker. He wasn't panicking, he was listening. He studied the railroads, the industrials, the steel companies, all the great arteries of America's growth. While others screamed for explanations, Dow sought correlation. He noticed something the panic-blind traders could not. Certain sectors had stopped falling. Even as fear gripped the market, these quiet leaders held their ground or began to rise. It was faint, almost invisible, but to Dow it was unmistakable, the first signs of accumulation. He began to document what he was seeing, not to impress, but to understand. He realized that markets don't turn when the news improves. They turn when expectations have been exhausted. The bottom, he wrote, is not a point of value, it's a point of maximum despair. By the time optimism returns, the opportunity is already gone. And so he watched as industrial stocks began to strengthen before the economy did. He watched as the market quietly rebounded while newspapers still printed panic. And then, like a whisper turning into a roar, prices began to rise. To Dow, this wasn't luck. It was law. He believed the market always discounts the future. By the time the public sees recovery, the market has already priced it in. And that became one of his most enduring observations, one that echoes in every chart to this day. Weeks later, Dow wrote an editorial that would become legendary among those who study his work. He didn't predict a bull market, he described the behavior of one. He explained how prices move through distinct phases. Accumulation, the quiet buying of informed investors. Public participation, the wave of enthusiasm that lifts the market. Distribution, when the wise begin to sell, and the hopeful refuse to believe. He didn't call them by those names yet, but his description was crystal clear. He was mapping human emotion in real time, from fear to hope to greed. That article and the insights that followed laid the foundation of what would later be called Dow Theory. A theory that every major technical analysis system in modern trading still bows to. Dow never lived to see his work fully recognized. But that single observation during the panic of 1896 changed how markets were understood forever. It proved that beneath every headline, every rumor, every irrational crowd, the market still obeyed structure. It still whispered truth to those patient enough to listen. If you were in Dow's shoes during that 1896 crash, could you have stayed calm when everyone else was panicking? Because while Dow's ideas brought him clarity, they also brought him pain. He learned that truth has a cost, especially when the world refuses to see it. And that's where his story turns from theory to tragedy. Every man who discovers truth must face the loneliness of being misunderstood. For Charles Dow, that truth came with silence. By the late 1890s, Dow had built more than an index. He had built a philosophy, a new way to see the market. But not everyone saw what he saw. To the brokers and bankers of his era, his theories sounded abstract, poetic, even. Trends, confirmation, market psychology. They mocked. To them, Wall Street was about profits and power, not patience and patterns. Dow didn't argue. He simply withdrew further into observation. He kept writing, kept explaining, kept sharing his quiet conviction that the market wasn't chaos, it was communication. But few listened. And for a man who had spent his life translating human behavior into market rhythm, that silence cut deep. Imagine the scene. Dow sits at his desk at the Wall Street Journal, the lamp flickering as rain taps softly against the window. A half-written editorial lies before him. He stares at the paper, then at the ticker tape unspooling beside it. The market is moving, as it always does, rising, falling, repeating its eternal heartbeat. He watches, but there's no satisfaction in it tonight. He's tired. Not from work, from being unseen. His theories had predicted the broad sweeps of market behavior, the waves of human sentiment, the natural rhythm of boom and bust, yet no one seemed to care. They wanted tips, headlines, winners, not wisdom. In that solitude, Dow began to question his purpose. Was the market meant to be understood? Or was it a mirror that no one truly wanted to look into? He once wrote, "The market tells the news before the news tells the market." But that kind of truth doesn't win friends, it challenges egos. It forces men to confront the uncomfortable idea that the market isn't moved by intelligence, but by emotion. By their emotion. Dow's health began to fade in those years. He was exhausted physically and mentally. His colleagues described him as thoughtful but withdrawn. He had seen the market's soul, but it came at a price. Because once you understand how humans truly behave in the face of money, the illusions of control, the cycles of fear and greed, it's hard to unsee it. It changes the way you look at people. It changes the way you look at yourself. And so, Dow's final years were quiet ones. He wrote fewer articles, watched the markets from a distance, and lived simply. No fame, no fortune, just legacy waiting to be discovered. When he passed away in 1902, he left behind no autobiography, no grand farewell. Only his notes, his editorials, and his theory, one that would later form the backbone of technical analysis, trend following, and even modern algorithmic trading. But the emotional low point wasn't his death. It was the fact that he never knew what he'd truly created. The world he tried to teach wasn't ready to listen. Not yet. Have you ever felt unseen for something you believed in, something ahead of its time? Share your thoughts below. Because years later, after Dow's passing, traders began to realize he hadn't been describing markets at all, he'd been describing human nature. And from his silence emerged one of the most powerful rules in all of trading. Every great truth in trading can be reduced to one law: the market moves in waves, and those waves are reflections of human belief. Dow's greatest breakthrough was the formula, a chart, or an indicator. It was a realization about behavior, the kind of insight that transforms how you see every tick, every candle, every surge of volume. He understood something few have ever fully absorbed. The market is a barometer, not a thermometer. It doesn't measure what's happening. It measures what people think is going to happen. That single distinction, that separation between reality and expectation, became the foundation of all his theory. Because when people expect endlessly rising prices, that optimism becomes unsustainable. And when despair consumes every investor, opportunity quietly returns. Dow broke this eternal rhythm down into laws, the kind that outlast headlines, wars, and even centuries. Law 1: the market discounts everything. Every known fact, every rumor, every whisper of sentiment, it's all already priced in. You cannot trade the news. You can only trade the reaction to the news. Law 2: the market moves in trends. Primary, secondary, and minor, like tides, waves, and ripples. The wise trader doesn't fight the tide. He rides it, measures it, and knows when to step aside before it turns. Law 3: trends are confirmed by volume and participation. Dow saw that when industrials and transports, the builders and the movers of goods, moved in unison, it was no coincidence. It was confirmation. A signal that the underlying economy was shifting, not just the price. Law 4: trends persist until clear signals prove they have reversed. He warned against prediction, the fatal temptation to call tops and bottoms. He believed you must wait for proof, not feelings. That's why his students would later say, Dow didn't predict turns, he recognized them. But Dow's deeper message wasn't mechanical, it was psychological. He was teaching traders to see without emotion, to detach from the noise and learn the rhythm of collective behavior. He wanted them to stop reacting and start observing. Because to Dow, the market wasn't about money, it was about truth. It revealed the crowd's faith, fear, and folly in real time. He once wrote, "No man can hope to succeed in the market unless he has patience to wait for opportunities." That was Dow's version of Livermore's rule. The big money is not in the buying or the selling, but in the waiting. Different eras. Same wisdom. Dow saw the structure. Livermore lived the struggle. But both arrived at the same timeless truth: discipline is profit. Emotion is loss. And that became Dow's breakthrough. The realization that the market's soul is not numbers, it's psychology in motion. If you can learn to read that, you don't just trade better. You begin to understand people and yourself at a depth most never reach. If you could follow just one of Dow's laws for the rest of your trading life, which would it be? Drop your answer below. Let's see where your conviction lies. Because these laws weren't meant to stay trapped in history. They were meant to evolve to guide a new generation of traders facing faster markets, louder noise, and higher stakes. The question is, do they still hold up today? More than a century has passed since Charles Dow drew his last chart, yet his laws still govern the digital markets of today. Think about that for a moment. In Dow's time, quotes arrived by telegraph. Prices traveled slower than rumors. Traders waited hours, even days, to confirm a move. And yet, his theories still predict the behavior of modern markets, driven by algorithms, AI, and instant information. Why? Because while technology changes, human nature does not. Dow wasn't studying numbers, he was studying people. And people, even behind screens, still move as they did in 1896. through fear, through greed, through overconfidence and denial. When you scroll through your charting app today, you're not looking at price action. You're looking at a psychological battlefield, the same emotional warfare Dow saw over a century ago. Every bullish candle hides the story of someone chasing too late. Every breakdown tells of someone capitulating at the bottom. Every consolidation whispers of collective uncertainty. Dow would have looked at Bitcoin, Nasdaq, or oil and seen the same rhythm he saw in the railroads, a primary trend driving the tide, a secondary correction cooling the crowd, and minor ripples feeding the noise. The labels change. The law does not. Here's the truth Dow left us. The more markets evolve, the more valuable timeless rules become. Because when everything speeds up, data, volatility, greed, patience becomes a superpower. Modern traders think they need better indicators. Dow would have told them, "You don't need better signals, you need better silence." To him, the trader's edge was never in prediction. It was in interpretation. Not in guessing the next move, but in recognizing the market's phase. Is it accumulation or distribution? Is this optimism or exhaustion? Those are still the right questions even when the charts are digital and the trades are automated. Let's bring this to real time. In the 2020s, markets no longer move in months, they can shift in hours. News cycles have collapsed into notifications. But Dow's message has never been louder. Trends exist until they don't. Respect them, but don't worship them. He would warn modern traders not to confuse activity with progress. He'd remind them that being early is the same as being wrong. He'd look at today's meme stock mania, crypto euphoria, and panic sell-offs and say, "These are not new patterns. They are old emotions wearing new clothes." That's the power of Dow's perspective. It's not outdated. It's decoded. He gave us the language to understand what has never changed, the crowd's pulse. So yes, Dow's principles still apply. Because every trade, every single one, is still a reflection of two timeless forces, hope and fear. And as long as those exist, Charles Dow's market soul still lives in every chart you read. Do you think human emotion will ever evolve beyond Dow's laws, or will we always trade through the same cycle of greed and fear? Drop your thoughts below. Because knowing Dow's truth is one thing. Living it, trading it is another story entirely. And that's what we'll explore next. How to apply Dow's principles, step by step, in the modern world. Knowing Dow's wisdom is one thing. Living by it in a world of dopamine-driven trading is the ultimate test. Every trader today wants the edge. A new system. A faster algorithm. A secret that others missed. But Dow's edge wasn't a tool, it was a discipline. A way of thinking that kept him calm in storms that destroyed others. So let's break down step by step how a modern trader can apply the same timeless structure that made Charles Dow see the market's soul. Step 1. Define the tide before you touch the waves. Dow's first principle was simple but sacred. Identify the primary trend. He compared it to the ocean, the tide that pulls every ship in its direction. You don't swim against it, you wait for it to turn. In modern terms, this means zooming out. Daily, weekly, or even monthly charts before you make a single move. Ask yourself, is the broader market advancing, declining, or distributing? If you trade against the primary tide, you might profit for a moment, but eventually, the current drags you under. Step 2. Confirm before you commit. Dow didn't trust single signals. He wanted confirmation. Back then, he watched industrials and transports move together to verify a trend. Today, your confirmation might come from correlated sectors, volume, or broader market indices. The modern translation. Don't act on one chart, look for alignment. When multiple markets sing the same tune, the probability increases that you're hearing truth, not noise. Step 3. Trade the market's behavior, not your opinion. Dow wrote that the market is always right, not morally, but factually. It doesn't care what you think should happen. It reflects what is happening. That means you must learn to observe without needing to be right. Detach your ego from your position. Trade what you see, not what you hope for. A modern application. If the structure breaks, exit. If the volume fades, step aside. Dow would call this respecting the reversal. Step 4. Be a student of silence. Dow's greatest gift was his patience. He waited. He watched. He refused to be swept away by the crowd's noise. In a world of social feeds, Discord alerts, and 10-second decisions, this rule is revolutionary. Create quiet spaces. Log off when uncertain. Let trends reveal themselves before you trade them. You don't need to chase the market. You need to interpret it. Step 5. Journal like Dow wrote. Dow didn't trade blindly, he documented everything. Each observation, each movement, each subtle shift in behavior. Modern traders have more tools but less reflection. Bring back the journal. Write what you felt, not just what you saw. That's how you identify your emotional patterns, your personal Dow theory. Step 6. Accept the human cycle. Dow's final and most profound lesson was humility. He understood that every cycle, boom to bust, optimism to despair, was inevitable. The wise trader doesn't fight it. He flows with it. So when fear dominates the market, Dow's student quietly accumulates. When greed surges, he quietly distributes. Not because he's smarter, but because he's learned to listen to the rhythm. That's how you implement Dow's theory in today's world. Not by memorizing charts, but by mastering your own impulses. Because the market's soul, as Dow discovered, is really a reflection of your own. Which of these 6 steps do you struggle with most? Patience, confirmation, or emotional detachment? Comment your answer below. Your honesty might help another trader see their own weakness. Because once you understand how to live Dow's wisdom, the final question